I'm curious because we also consult with advisors on how to prime and get out in front of a move and how to establish where the good fit is and how to actually go into motion. I'm curious, have you seen what motivates an advisor to transition from one firm to a next changed in the last 10 years? Because I have. I'd like your perspective on that.
It's a great question. And I'll give my answer, but then I'd like to turn the microphone around to you and hear from your vantage point, the change. I think probably I'll give you three things that I've seen change firsthand. The first one is advisors, when they transition, everyone's frustrations or pain points or situation is unique to them. It's like a fingerprint, right? Like everyone experiences things differently, has different businesses, et cetera. But the three buzzwords that kind of encapsulate everything is freedom, flexibility, and control. That's what advisors want more of. And when they consider change, they're typically frustrated by a diminished amount of those three things, or that's what that's going to be their lens for evaluating another firm. So that's one, is just I think the common pain points are more about autonomy than ever before. The second one is we've seen advisors become much more long-term oriented. So we still see some folks who they move every 10, 12 years to get a check. Nothing wrong with that. It's their prerogative. They deserve it. But more times than not, we're seeing folks move, even if they're somewhat happy, because they are looking to protect the business for the next generation, or they want to build something that's truly theirs, where they own the equity and they can customize everything. And we're seeing teams, even teams that are younger, who in the past, they used to be, I'm 40 years old, I'll go take a deal from a firm. When I'm 50, I'll have a lot more money in my bank account and I can go independent. Now we're seeing that if an advisor is, let's say, sub 45, sub 50, they're much more likely to want to become business owners than ever before. So I think that's change number two. And then I think the third change we've seen is that advisors are looking to do more for clients. So I think fee compression, you'll probably agree, is not really happening like it's been like has been predicted. But advisors face more competition from robos, discount brokerages, self-directed platforms, tons and tons of RIAs, all the major banks, insurance companies. So advisors have to do more for clients to protect their same fee level. So whether that's tax services or estate planning or more concierge and family office services, bespoke private investments, advisors are they're either looking for access to more or to have the shackles taken off where they can offer more, to have a more defensible position in both keeping their current clients, but also as they're prospecting against folks that can probably do it for cheaper.
The third is obviously that practical fit around compensation, not just in terms of income, but how is this going to impact enterprise value so I can fully monetize my life's work? That's oversimplified, but I'm curious how you feel about that frame and if that lines up with the way you see this.
It definitely does. Every engagement we have with an advisor or a team, we take them through a 20-question self-assessment. And they're more of the qualitative questions, what's frustrating you? If you had a magic wand, what would a new firm look like? How important is an upfront deal versus payout versus equity? They're questions just to give us a really good understanding of how best to make recommendations to that advisor, but it also fits with our philosophy, which is you got to know what you're solving for before you dive into action. So you have to kind of build the plan, kind of the framework by which you're going to evaluate other options, because I think a big reason advisors kick the can down the road, especially with transitions, is transitions are hard work. And at the end of the day, no financial advisor, those quality ones, are going hungry. That they're all making decent money for the most part. Even the most unhappy financial advisor has much more autonomy than a typical office worker who's a coder or who's in the construction industry. So advisors have a pretty good gig. So what you're saying fits very well with our philosophy, which is beginning with the end in mind and being strategic about how you view things. And then you can kind of make heads and tails of all the different options that are out there. And on the economics, like we said, the longer term orientation tends to win.